Welcome back to Passive Income Pilots, everyone. Tait Duryea here with Ryan Gibson. How you doing, man?
I'm doing great, Tait. Excited for having our listeners listen to another exciting episode.
Yeah, this was a really interesting one because Ryan and I are deep into the real estate space, but venture capital, angel investing, that is all new to us. So we are along for the ride, just as you are on this episode. And boy, who better to talk to than Nick? Ryan, you want to tell our listeners a little bit about him?
Yeah, have you ever gone to a app called OfferUp and bought something from somebody, or maybe perhaps you've sold something? Nick Huzar has actually started that company. He was a co-founder and one of the original members that started up OfferUp back in 2011. And he launched this company. It has over 44 million downloads of the app, and it does over 4 billion in transactions every year. So he took the company from an idea to a multi-billion dollar company. So we're going to hear his story, and we're going to hear some about his early on investors. We're going to hear about his personal journey, some of his failures, some of his successes, what he's working on today. He's working on some really interesting things that we'll talk about later in the show. And for our listeners who are tuning in, they're thinking, why would I be interested in this? One, I think it's a fascinating story. But two, we also are helping practical knowledge and insights by explaining what an angel investor is and how could they benefit from investing in a company like OfferUp years ago, or what are some of the downside risks. And we're actually going to talk about what an angel is, what a VC, venture capital, or private equity is, and the differences between all those things, some of the risks that are associated with being involved in that, and really who can be a VC investor, private equity investor, or an angel investor, and how that all breaks down. But a little bit more about Nick. He grew up here in the Pacific Northwest where I'm at. He went to University of Washington, go Dogs, where he earned a degree in communication. He's passionate about using technology to improve people's lives, which he's impacted many people, making it easy to sell things, much easier than the clunkier version, Craigslist, that you may have used. And he's received numerous awards and recognition, including being named one of Fast Company's most innovative companies in 2017 and 2018. So with that, let's get to the show.
Welcome to Passive Income Pilots, where pilots upgrade their money. This is the definitive source for personal finance and investment tactics for aviators. We interview world-renowned experts and share these lessons with the flying community. So if you're ready for practical knowledge and insights, let's roll.
Welcome back to the show, everybody. I've got Nick here. Nick, thanks for joining us.
Thanks for having me.
Nick, you've got quite the story on starting OfferUp. Why don't you give us a little bit of background about yourself, how you came to start OfferUp, and the story behind the company?
Yeah, happy to. So I often think sometimes companies are birthed from your own frustrations. And so OfferUp was not my first company, but it's definitely been the most successful one. And I had a wife that was working and a daughter on the way. And I had a room full of stuff. Most people have that junk drawer in their house. I have one of those too. But I also had a room full of stuff. And when my wife said she was pregnant, I'm like, this is awesome. So I go into dad mode. I open the door and I'm like, kill me. How am I going to sell all this stuff? And I was like, this is going to take me forever to post it on Craigslist. There's got to be a better app or something. And so I'm looking at my first iPhone, which is the second gen iPhone. And there's no Android phone at the time, by the way. And I just gesturing like this. I'm like, why can't I just take pictures and make this stuff visible? Like, why is it such an ordeal? And then I probably spent 5 months trying to convince myself not to do it. Here I am, my last company, I was sleeping on an air mattress. I moved on. There was an investor and a former co-founder running it. And so I was like, I got to get a job. I don't want to be a deadbeat dad. I have a daughter on the way. My wife's working at Microsoft. I just quit that company. So that was my focus. But I kept thinking about that and I just kept drawing, mapping out what it could be. And I just kept, and there was a few apps in the app store already doing it. I just thought they were terrible. I'm like, these are terrible experiences. So I just eventually said, I was looking at the problem space and looking at like how much value is stuck all around us. And it just blew my mind. I was like, why is our homes getting so big, but we're having less kids? I need the storage business. Why is 10% of the US population rent storage units? Like 25% of US households can't even park in their garages anymore. And I'm like, this is crazy. And so my conclusion was it's because of time value. We all make time value decisions. And that's why stuff sits often. And so the advent of the smartphone was a game changer because now I no longer had to take a picture and connect my USB to my computer, take 15 minutes to upload it. I could just in 20 seconds take a picture of something. And our belief was if we could focus on a very visual experience. And by the way, if you look at Craigslist, for example, it's not that. Imagine, I don't know who designed, Craig Newmark decided to design that thing, but imagine going into Nordstrom's and you see all the tags first, all the text first, then you look at the item. Like, this is the worst shopping experience ever. We were building our app and designing the app to be what I call like your lens to local. Like, I wanted you to just window shop and make it enjoyable from your phone, which by the way is a lot. And I usually see a lot of apps are like that all day, but at the time, like nobody was doing that. Like, it was a lot of engineering work to pull it off and make it work smoothly. So I think that was, like I said, it started from my own frustration, which then led to curiosity, which is how big is everyone have this problem or is it just me? And then I realized, wow, this problem is huge. And my math was, if I could even just get 1% of the market, we'd be a big company. We're way bigger than that now. And so that was the initial kind of spark and the pain point, which at the end of the day, I was selfishly just trying to solve my own problem. And I guess the belief you had to have too was like everyone was going to have a smartphone. Like I said, we started writing code before there was even an Android phone. So luckily that trend continued on and we were able to take advantage of that.
Nick, can I walk it back a little bit and ask what made you an entrepreneur? Like, what drew you to starting companies versus working at Microsoft?
I am not a good employee, I don't think. I don't like being told what to do. I'm also pretty creative. I think of things very differently. So I don't like being put in a box. I think I move at a different speed than working in big companies. I've worked for very short stints in large companies and that was miserable. And I started my first company when I was 22, like 6 months out of school. And so I just felt like I really love building things. Like, I think of business as like the most creative thing I could do. And so I get a lot of joy from starting things and watching them grow. And I look at the challenges and just puzzles and it makes things interesting. So I don't know. I've always had a commitment to myself that I was never going to work for anyone. This is 18 years ago. I was at T-Mobile and when I decided to leave, I told my now wife that I said, I'm never working for anyone again. And we were camping and I took my badge and I threw it in the fire. And I never did it. That was 18 years ago. I never worked for anyone again. So
that's incredible.
Yeah.
So how did you, when you were building OfferUp, you had the idea, you realized that this is a huge problem and you wanted to build it. How did you pull together the engineers? You said you were writing code and how'd you pull the money together? Because that kind of leads us into the conversation we want to have today about venture capital and angel investing and that sort of stuff. What was that process like?
Fortunately, I had a co-founder who used to work with me in my previous startup. And that startup was barely getting by and he was able to help him make ends meet. And he knew I was out there. And one day I said, hey, I'm exploring this. What do you think? And started a little, slow. And then eventually we started really getting into it together. And so between the two of us, and then I think we found one of our early iPhone developers was like in high school at the time. And we had talked to his parents, but like nobody was hardly coding apps back then. And between, I'd say, two of us full time and some other part-time help, we were able to launch the first product. Like, I did a lot of the design. I coded on the website myself, but I'm not an engineer. So he did all the back-end work, set up AWS, which back then, by the way, was very risky because everyone used to put things in colo facilities, build your own hardware. We're like, what's this cloud thing? So we were very early in cloud. And so that we took advantage of that. And also networking. I think in the early days of companies, you just got to network your butt off. Like, I am not shy from going out to every meeting. And I used to have a t-shirt that says like developers wanted, and I put every coding language that we were using. And we got an engineer from that for my $25 t-shirt.
That's such a good idea.
That's amazing.
Yeah. I was just at an event and some guy's like, I know how to do all that. I'm like, great, let's go grab coffee. So I think in the early days, you got to scratch and claw, right? You got to find ways to talk to customers. You got to do all of it. And that's how we were able to get going, is we just had a handful of us that were scratching and clawing for a long time.
Where did you grow up? Did you grow up around here? Seattle?
Yeah, my father worked for Boeing, so I grew up in Kent.
Oh, nice. Okay. Growing that network, can you speak to that a little bit? I'm always interested in networking and how do you even take that first step out there to be at a conference where you're wearing a shirt and you're just looking up programming conferences?
I spent a lot of time trying to meet everybody. I believe that where your life takes you is through relationships. And being smart is somewhat helpful, but I think it's mostly who you know. So I just I would always get very focused on, okay, what are these different events I could go to? I'd reach out online, and it was just through one connection would lead to another connection. Like, you just got to keep doing that a lot. And that's how I was able to get out in front of people, get out in different conferences. I've pitched every single VC in Seattle. I've pitched every single investment group in Seattle. Like, I've done all of that. But it just takes time, right? There's no way around it. Like, you just have to put in the time and go do it. And if you're building something really big and meaningful and also something that's pretty novel, then expect to hear no's all the time, right? So you just have to have thick skin and just keep going.
Yeah. As we say, your network is your net worth. You make it bigger, and the more people you know. And it's really why we started this podcast, is to expand our networks, Tait and I, and also to expand the networks of our listeners. You listen in, we've got a big variety of guests that we have on, and it really helps connect the world to different investing. But I wanted to get into that VC angle. Tait and I are heavy into real estate syndications in general, and that's a new world to our listeners. Most of the listeners that come on or listen to our show they've never heard of alternative investing, and now we're in this even more new arena of VC investing and getting angel investors to come participate in companies like OfferUp. Can you speak to how that worked, who you went to when you said you pitched a lot of the venture capitalists? What is that?
I think, when you're going out there and you're presenting to people, you're telling a story, right? You're talking about why, what I was starting with OfferUp, like, why the hell did I start this company? And so that's part of when you're getting in there and trying to meet with somebody. And then you get into this vision of, like, where are you going? What's this opportunity you see? How big is the market? What's the competition look like? What's your team look like? What traction do you have? There's this very common kind of things that most people should have in most pitch decks. And I think it's about finding also the right investors. Like, I'd have meetings and I'd pitch, and I'm like, clearly these are not the right investors. I would take the feedback and go, okay, thanks, but yeah, no thanks anyhow. And so I just move on. And so I would say, again, you get a lot of no's, right? A lot of people saying, oh, it's too early, you don't have enough traction, or how are you going to compete with Craigslist? I get that every single time. And so I think it's understanding objections and then sometimes tweaking them. If I was to hear 5 of the same bits of feedback and I didn't act on that to make my deck better, then shame on me. So I would always take that and just keep iterating. So I always tell people, get out and start pitching all the time. Tell everybody, because everyone's always worried that, oh, my competition or someone's going to kill me. No, lack of execution is going to kill you, right? So you got to execute all the time. And so in the early days, I used to be like that with my founder. I'm like, we had a few other competitors that raised millions of dollars. I said, I think they're going the wrong direction. I said, we just got to outwork them. And we just worked every single day. Like, every single day, I was in my pajamas, like, we did whatever it took. And luckily, we did out execute them and raise more money, and then became the leader in the space. But that's usually in the early days. What I think about is just keep focusing on the product. Yes, go tell your story to as many people as you can, get feedback, and keep tweaking your deck. If you look at the first pitch deck I presented on OfferUp versus the one that actually we used to raise our Series A, it looked very different. And it was only because I got so many no's and learned from that and kept tweaking. But by the end of the day, it was still the same vision. It was exactly the same product I wanted to build. I didn't change any of that. But how I talked about it, how I approached things, and that was definitely different just through the early meetings I was having. But like I said, I was meeting with angel investors, having coffees, having dinners, going to meet with venture capitalists, meeting tech stars. I would meet with anyone I could to try to see if I could, raise some funds in the early days.
So going back to that high schooler you hired, did you have the money to pay them, or were you having to scrounge friends to invest in the company at that point?
Nope. So one of the things I do in the early days is I try to be pretty generous with equity. In that case, luckily it worked out very well for him, because I said, look, I can't really pay you, but I can give you some equity. You want to work for free? And then that worked. And I did that a lot with a bunch of early hires, where the conversation, I think sometimes, and people feel like they need to raise all this money to pay all these people like these market salaries. And I just feel like then you're not hiring the right people. You need to find people that have the startup stomach, that want to come in there and build something great, knowing that there's high risk and, hey, it may not work. So I would flip conversations sometimes with our early employees. And one of the guys I hired he's out of college, and normally you ask him, what do you want to make? And I asked him, I said, look, I'm not going to ask you that question. I'm going to ask you, what do you need to live? And then I'm going to give you a lot more equity. but you're not going to make a whole lot of money. And luckily he doesn't work anymore. So that worked well for him. So
You've
that's
got
the
enough to
risk.
live now.
That's the risk you take. But it shocks me still to this day. Like I've seen some founders that are like starting their company, having just raised an early round. They're going to pay themselves like $250,000 salary. I'm like, this is ridiculous. What are you doing?
Yeah.
And so I think I'm not saying you should starve yourself entirely, but I think having some skin in the game is helpful.
Can you lay out, so that's fantastic, by the way. I love that attitude. I think Ryan and I can echo that sentiment in our businesses. We've been very scrappy in the beginning, but what's the landscape? We wrote down prior to the show, angel, VC, venture capital, private equity. What are those things? So you said that you were pitching some angel investors early on. Who are those people typically? Are they super high net worth and this is what they do. This is their thing. This is what they like to invest in as early stage companies. And what's the difference between angel, VC,
and private equity? Yeah. And when we raised money, we raised over $380 million at OfferUp from all of those groups. And I think in the early days, like with angels, that's what it is. It's usually an individual has a high net worth and they're excited by something they believe in, either the founder or the story. And so they're like, hey, I'm going to write you a check. And so that's hard. Like in the early days of OfferUp, it was like $25,000, $50,000 checks. And it was also a lot of no's. I'm going to a lot of meetings, trying to build a product, trying to build a team, and hand to mouth feeding for a while. We did what they call in the current market, it's called like a safe note. Think of it as just it's very simple, two pieces of paper usually. And the benefit of that structure is it's just open-ended. So I could raise 50,000 and then 90 days later raise another 50,000 versus doing a real equity round. Usually what you hear is like Series A. And the challenge, of course, with that is it's hard to price companies early on, and you have to get everyone around the table at once, and someone's got to lead and do all the work, and then everyone's got to eat at the same time. And if that doesn't happen, it all falls apart. So it's interesting because now we're back to the camp now. I started OfferUp 10 years ago, and doing notes pretty early was common. Now that's pretty common, even for bigger rounds now, people are doing that. And it's probably just a sign of it's more kind of trendy now. It makes more sense given where the market is. So those are the two different flavors usually of financing. The benefit of the note usually is it converts when you do a real equity raise, but it's usually discounted. So let's say I'm starting a company today and like, I want to raise $1 million and let's say it's on $10 million kind of valuation. So I'm giving up 10% of the company. If I had a note already in there, let's say I raised another, whatever it was before that, usually it discounts. So instead of it being 10% for the note holder when they do the price round, maybe it's 30% discounted. So they convert it like 7 million. So they're incented to come in. And then the note also carries, it was like a loan, usually carries an interest rate. So that's typically how it's structured. It's a lot simpler paperwork. It's easier to do. And we survived, by the way, for 2 years on a note. It was hand to mouth feeding. Having 4 months of capital in the bank was a luxury. And that's how we kept OfferUp alive in the first 2 years because no one was funding us. Like it was really hard. Shouldn't say no one, but we were just scratching and clawing constantly. And so ultimately we did our Series A probably 2 years after we started the company though.
If I'm listening to this show and I'm a pilot and I make $300,000-$400,000 a year, is it a good idea to find a guy like yourself? Obviously, it would have worked out very nicely. But is this the pond I want to fish in? Do I try to find somebody like you who's running and gunning, has a good idea? Where would I even find you? Would you even want my money? What's that look like?
I think that the challenge playing is that I think about it, the angel game. It is a game of numbers. And so for me personally, I'm very selective on what I will invest in. And part of it is it's a time thing. I think the best companies, if you want a breakaway company like a Facebook or something, like that rounds to zero. Like the fact that OfferUp is the size and scale, and if you think of the probabilities, it rounds to near zero, right? And so there's plenty of safer ways to put dollars, put in the S&P, right? But if you want outsized returns, you got to take risk. But I also say like writing one little check into one thing and just hoping that works, that would be, I think, challenging. I would say you need to get into the mindset of I'm going to allocate X amount of capital and I'm going to do maybe smaller to start, like $25,000 checks or whatever, but I'm going to try to do 20 of them over the next 24 months. And then I'm going to go to events. I'm going to go to whatever things you do. And I'm trying to get exposure to these things. because it's too hard to know if it's going to work in the early days. There was very little signs other than literally 90 days of traction here in Seattle that we could be installed 147 million times. And you don't know that. And so I think that's the risk that people take early on. But I think just going all in on one thing, you could try that, but I think it would be a little too risky to do that.
You said that you really refined your deck. You kept pitching in the same thing, but you had to keep refining it. And then obviously you were successful at not only raising the money, but also executing on the company. What would be the thing that an investor would see in a potential angel investment that would go, aha, I'm going to put my money on this one? Because once you open up that network, you might have a lot of opportunity to see a lot of different companies being pitched. But what do you look for? What would you see that's the founder I want to be with? That's the guy that's gonna not quit, who's gonna figure out how to hire labor that's aligned with the company's purpose and really explode.
I'll answer that, but I also wanted, I thought of one more thing I wanted to say too from the previous question. So back to the pilot example, I would say, if you say, hey, I don't want to go do all that, it's a lot of work, then you could invest, you can be a limited partner in a fund. So there's a handful of funds in Seattle, and that's what you do. Say, oh, I'm going to write whatever, $25,000, $100,000 check. Maybe it's a bigger check, and you're going to pay a small fee. But now you have somebody that's out there and they're investing in all those different things. And so that could be one alternative for somebody that's just, I just don't have the bandwidth. I just want to write a check to somebody, but I want exposure to those types of opportunities because historically venture capitalists had pretty damn good returns if you're investing in the right people.
Yeah, and to be clear, this is like a pool of startup companies that an investment manager is picking on the behalf of the fund. This isn't like real estate or anything like that. This is specific to the types of companies that you founded.
Yeah, so you might have somebody in Seattle and they run a $10 million early stage, like seed / Series A fund, and they're writing like $250 to $1 million checks. And they're going to probably have 20 companies out of that. And hopefully a handful of those have really good returns. And that's how I think about it. And I would also think about it as being like a 10-year kind of commitment. Like that money is gone. It's going to sit over there, hope it does well, and check in after time when that fund kind of matures and see where you're at.
I think that's such great advice because, as Warren Buffett says, right, invest in what you know. And if you're not looking at these consistently, it's very difficult to know what you're looking at. I think one of the most likely scenarios for people like Ryan and I are who don't know the space and we're not, what was it that you've been to?
Keiretsu Forum.
Keiretsu Forum.
Like where VC angel investor.
Bunch of companies are pitching. But I think the most likely scenario for the typical pilot is a buddy comes to them and says, hey, I'm starting. Do you want to angel invest in this? And they're like, and they just don't, there's no context because you're not looking at 20, 100 different decks and picking. Going back to Ryan's question, it's sure there might be some element that really stands out and makes you say, this actually looks really good. But if you're not looking at hundreds of these things, it might be very difficult to know what you're looking at.
Yeah. So your question, Ryan, was like what I look for. And I think that hands down, like who is the founder and is he or she going to just go all in on this, burn the boats? And I think I've heard that from a lot of our early angels that just knew that from me. That's who I am. When I'm committed, I'm in and there's no stopping it. And so that's thing one. Do you have resilience? Because a lot of people, it's too hard and they quit. I just think it's Tuesday, right? It's just, I found in the darkest days, at the last minute, a door opens. So I believe in that. And I believe in manifesting. And I just keep charging. So I think that needs to be there too. Do they bring something to the table more than the idea? And I've seen this so many times. I have this idea for blah, 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 this tech thing. I'm in real estate. I'm like, you're never going to do it. Never going to do it. Because the idea, it doesn't matter. Who cares? Can you put it together? Can you put a product together? Can you put a team together? Do you know how to hire? Like all that stuff. I think that the idea doesn't matter, but you need to bring some other element to it. So like at OfferUp, like I designed the name, the logo, the app, I coded the website, right? I brought in the first engineers. I worked on the pitch deck. I worked on the marketing. I talked to the customers. I built out our sales team. Like I was able to do that. And then for the things I wasn't able to do, I had brought other people in the team that were really good and were able to do that. So you got to find somebody that can pull all those elements together and have a vision to be able to articulate it, I think, very succinctly. That's another thing when I'm giving feedback usually for entrepreneurs is when I look at their deck and I just want to die. I'm like, dude, you got to be able, if you're going to attract people to come on this journey, you need to be able to articulate it in a way that resonates and captures them and is exciting versus just text after text. And nobody wants to read that. So I think those are all things that are important. You got to be able to communicate, build a team, have resilience, bring something else to the table. And then also, are you going after, can you compete in the market and what's unique to that? Without the smartphone, we wouldn't be talking. There would be no OfferUp. So that was the unlock that I saw. But if we were things like you could do on the web, then why should we exist? Just use Craigslist.
I remember that specific period of time. My first smartphone was an iPhone 2. And I just remember thinking I should probably be learning coding, but it's too late. And it's just so cool to hear the story of you're on your second iPhone and you're like, why can't I just take a bunch of pictures? Let's go. It's just such a inspiring story of just taking action. And I think to your point about sizing up an operator, going back to your first point about someone who's going to go all in and burn the boats, how do you suss that out? What kind of a question would you ask somebody, or how do you see that through somebody? Because everybody's going to say, oh, I'm all in and this is what I'm focused on. Is there any kind of...
Sometimes it's probably I think the experience too. For me, people had seen I had actually done other companies. And I think especially with certain investors, I've heard, we want to see that you've done stuff and failed. We want to see that you've learned. Sure. And so I think that shows a level of resilience, and you're going to really get after it and do it versus, oh, I just got out of college and I have this idea. Look at my pitch deck, fund me. And so you haven't done anything. The other point that I think that I know I focus on a lot is, are you just taking action? Because I tend to learn from, I'll use a good example. My wife is wicked smart. She's like a 4.0 kind of student. So she will sit and assess. And when she commits, it's going to be awesome. But I'm already running, right? And so I always say, if we're taking the mountain, I'm going to beat her to the top. I'll probably have some bruises and scrapes on me and I'll be beaten up, but I'm going to probably beat her. And I think that in the world of companies, you learn through action. So I tend to I have enough. It's never going to be perfect data. And I just start going, just start running. Let's go. And just start to figure it out and cobble it together, and things are breaking as you go. I like that kind of entrepreneur because I think they're going to learn faster versus other ones I've seen, which is, oh, I told you about my idea. And 6 months later, I go, you don't even have a product, any prototyping? What have you been doing for 6 months? Oh, we end up researching the market. What are you doing? So I think that sense of urgency, but through action, I think I would look for that too.
Yeah, two things.
This is how Ryan and I,
which is
learned real estate. No, this is how Ryan and I learned real estate. We've lost money. We've done bad deals. You just got to be in the ring.
Yeah.
Part of, again, why we have this podcast is try to shortcut our listeners' journey so that you can not make some of the mistakes that we made along the way. But that's great. Ryan.
No, I was just going to say, we talked about this podcast for about 5 years, and maybe I'm guilty here, Nick. And it was just finally can we just sit down and hit record? And then here we go. We've got.
No one listened to podcasts 5 years ago. So there you go.
That's true. But the takeaway there is perfection is the enemy of done. I loved how you said that. It's just go, and you're going to get banged and bruised. The other thing too that you really said and quickly is, I want to see somebody who has failed before. And I think as pilots and as investors, we look at people who have failed as, oh, you failed at that. I don't want anything to do with that. And I think that is one of the biggest mistakes you can make, is
Absolutely.
glazing over somebody because they've had failure before. It's, how much you learn in the darkest of times, and when you're failing, that's the person you want to hire. They've gone through the mistakes of what can happen and go wrong. That you don't have to deal with that failure. They've already experienced it. Obviously, you want to make sure that they have the right ability to learn from their mistakes.
Yeah.
But I think that's such a critical thing.
There's nobody I know that's wildly successful that doesn't have a ton of stories of how they failed. If you're not failing, then you're not pushing enough. And I'm working on a few other ventures right now, and I'm learning new stuff all the time. Oh, damn, that didn't work. So what? You have to overcome that to learn and grow as a person. But I do think a lot of people get comfortable in the roles they're in and oh, this is fine. And okay. But I think in the world of entrepreneurship, I'm talking about more of a job now, but in the world of entrepreneurship, I don't think that has a place. You need to keep pushing and stretching, or else somebody else is going to come along and innovate, and they're going to start to, and I think that's the thing that I always am mindful of is, am I growing as a person all the time? And yeah, it's uncomfortable a lot, but I think it's a mindset. That's another thing too, is you control your mind and how do you think of failure and challenges? I have no fear, by the way. I don't fear anything. And so I think when you can let that go, then you can focus on things and just keep moving without losing sleep over it.
Yeah. So we tackled angel investing. So that could just be anybody. Just
anybody.
you could invest $25,000 into some random startup and you are an angel investor. Congratulations.
Yep.
Talk about venture capital.
Yeah. So venture tends to be much larger. And usually I think with most venture companies, again, it depends on the market. Some venture companies will do like an idea, sometimes based on the founder, right? The founder's been proven and you just have this idea, I want $6 million. That can happen. But usually folks want to see some level of traction that if they put in dollars, what is it going to look like over time? Versus usually the seed folks or the angels, sometimes it's just an idea, right? You barely have any traction, right? And so I think that's the delineation I would think about. Also, the check sizes are much larger. You're raising way more capital. And so when you're taking venture dollars, again, they're looking for meaningful returns. And as soon as you raise $70 million, now you have to invest it in the business. And then that becomes a whole nother animal, which is now you're really growing, right? You're going from a very, very small number of employees to a lot, and you just have a lot more things to deal with. And but the benefit again is you can accelerate what you're trying to do. Your profile is now elevated so other people can know what you're up to, which is good. And most venture funds, especially the bigger ones, have like billions of dollars, right? Their LPs are not limited partners, or people investing in those are not writing them typically $25,000 checks. They're very high net worth individuals. They're endowments, right? Sometimes they have billions of dollars under management. So there's varying levels of scale. Some venture firms will be seed A and they're writing smaller checks. Some will go the whole gamut, like they'll do all the way to a public market and they're investing all along the way. I think it depends on the fund. And then the last thing I'd say is the other one was private equity. So private equity is usually what I consider. It's been interesting to see in the last decade what's happened. We have T. Rowe Price and Tiger Global invest in us, and they're private equity companies. I remember when they started to invest, talking with other early investors, said, they're never going to invest in you guys. They're not public. And I'm like, I don't know. Like, we're having good conversations. And they ended up investing. And I think that was just how the market, when the public markets they were trying to get more value by moving into private markets, which makes sense. But typically they've been more public market investors because they can get their money in and out. And when you're private, like, you got to find some type of liquidity, and public markets aren't always guaranteed, or a buyer isn't always guaranteed. So private equity, I typically think of now as like the later stage stuff. It's usually where you can really add a lot more capital, but also I think they're looking for a different type of return. Maybe they're okay just doubling their money or tripling their money versus the earlier venture capitalists or angel investors. They're looking at, can I 100x my money? They're looking for a different return. So I think that's the other kind of animal that's out there is private equity companies. But historically, they've done, like I said, venture and private equity in particular it's the best investment vehicle for the biggest return.
So your first angel investor, think about the guy or gal that put the first dollar in. If you don't mind sharing, like when did they actually, how many years later did they recoup their initial investment and make a profit?
So I won't give out his name. I'll give you a high level though. He was our first $100,000 in on an idea on very little traction and like barely a prototype.
Nice.
A few years in, we did a secondary and I think he made 340x his money, maybe more.
Oh my God.
Yeah. When I called him on the phone, I said, are you sitting down? I said, I want you to remember this. I am going to be the best return you've ever had in your lifetime. And I said, we have some people that are really interested in what we're doing. Would you like to sell some of your shares? He sold almost most of his shares. He still has some. And now he runs his own venture capital firm and invests in lots of other companies. So he did extremely well. And by the way, after he put his money in, I had a hard time raising for 2 more years. He never put another dollar in. He wouldn't. And so it's okay. But he still did very well.
Wow. What I want the listeners to connect the dots on here is not that angel investing is a higher return, so I should go do that, but the risk profile, right? Because I think that we've said this on the show in the past, but it's just a fact that retail investors are typically not great at evaluating risk. If they see this is a 25% annualized return and this is a 20% annualized return, I'm going to go with that one. Typically, unless you are really in the space, whether it's real estate or VC, angel investing, whatever it is, it's hard to quantify and get a grasp on risk. But the reason the returns are that high at that stage is because the risk is so high. So obviously, you're wildly successful. For every wildly successful company, there's going to be 100 that don't work out, right? You lose all your money. It's not like a tangible asset like real estate where you're always going to be able to get something back as long as you didn't buy it irresponsibly with too much debt. It can go to zero. So anyway, I just wanted to make that note.
Let's talk, if you don't mind, Nick, sharing some of the failures, right? You said you mentioned you started multiple companies prior to OfferUp and maybe they didn't go so well, right? Would you mind sharing a couple of stories on maybe investors that didn't have a great experience?
Yeah, my last company I started before Friendster. Do you guys remember Friendster? See,
the name.
no,
you got to remind us.
Hold on. I'm going to keep going until we hit to where you know. What about MySpace? Do you remember MySpace? Do you remember MySpace?
You remember MySpace.
Oh, most people give me that weird look on Friendster, which is hilarious. So I started this company, Friendster. So I was doing networking events, like big tech events and like in my late 20s and saying, God, we should connect online one day. And the best example me and my co-founder had was looking at dating sites. I'm like, there's 3,000 dating sites in the world. So that's weird. I was like, they all work the same under the hood. They're just reskinned. And I said, what if you could just build a network? Because networking is really inefficient, right? You're meeting people all the time and it's all you're going to these events and it's not always the greatest. So we looked at these dating sites and said, what if we could mimic this, but then connect people on like interest level? So you guys are connected and maybe there's an area of real estate or there's another one and they could have these so we filed a patent around how we saw humans clustering and built this company around it. And we raised money from a lot of angels, which was painful. I think it was like 50 something angels. Like I always say that my job was raising angel money. And then on the side, I had a company to try to build. And it was just painful. And so I think it was the challenges there was just a lot of learnings. It was like hiring the wrong people. It was the wrong investors, quite honestly, like wicked smart people. But we had people on our board that were like owned accounting firms and real estate, like awesome people, but it didn't really strategically help us at all. And so we had just a lot of, I think, the wrong team, wrong approach, wrong go-to-market was part of it too. And we were really freaking early. And I remember also when Facebook came out, I was like, whoa. And like this term social media. So sometimes building companies, sometimes it is about timing. I think in that case of that company, we were just so freaking early, like so early and nobody knew. No one's going to connect online. It was just weird time. And so ultimately, like we tried to pivot a few times and go different directions. And that didn't quite work either. We had a guy that was a big investor that came in and he was literally drinking like at work, wasted. Like he passed out. I took a picture of him. He passed out in a board meeting on the table.
Holy cow.
I was like, oh, this isn't fun. So
wow.
Over time, when I decided to move on, I realized, wait, this ain't going to work for a number of reasons. And then I said, look, I'm not going to have anything to do with this. I do not want to have a partner that's not in it mentally, and that's not going to work. So I told my co-founder and him, because he was ultimately very hands-on when he wrote a big check. I said, I'm going to part ways there. Fortunate, but I learned a lot from that. And like I said, I didn't have plans on starting OfferUp. It was just a pain point. But maybe I just had a level of, could be arrogance or just crazy like that. I'm like, I'm going to go at it again. And I'm happy I stuck with it after that. So
yeah, you started the Facebook before Facebook, the intermediary between MySpace.
I would say the shittiest version of Facebook. Yes.
Okay. Gotcha. I think the point here is to talk about like as successful as you are, those investors didn't have a 340x return, I would imagine.
No.
So,
everyone went to zero on that one.
Yeah. So it's fun to talk about amazing risks that people take in the rewards, but also just balancing that with the chance that you could lose your money.
Yep.
And a good example of a great outcome eventually.
Nick.
Yeah, that was great. You mentioned angel. If you're an angel investor, that's like you're investing in an idea. And I love that. As a VC investor, it gets mature.
More to traction, once you're usually, sometimes you'll have traction in a seed, but usually it depends on the VC, I'd say. But yeah, in some cases, they lean way more on the traction.
Can I ask what qualifies it as a seed versus an A versus a B, Series A, Series B? Where did those terms come from and what do they mean?
Think of those as just milestones of like where the company is at. Like in the early days, if you're doing a seed round, in some cases, you might not even have a company incorporated yet. That's a good example. Or you've got very little traction or very little team. So everything is small. Nothing's really you don't always have product market fit. Like you haven't always figured all of it out. When you're doing your A, it's usually like your first meaningful, really good size check. And now you're building out your team and you're getting more scale. And then it just keeps going. Unfortunately, sometimes there's companies that raise Series F. They just keep fundraising. In some cases, I don't know what Uber did, but Uber is a good case, great example of raising a lot of capital, but also a good story to see that thing turn the direction that it did. And so that's usually how you think about it is every time you do a round of funding, ideally you're raising up. It doesn't always happen, right? You can do what they call a down round where it was less than the previous valuation, but ideally you're raising more and you're raising up at new valuations. And typically when you're doing that, the investor or the venture firm they're just owning a percentage of the company. So I think a good rule of thumb is typically 20 to 25% every financing, but as it matures, you can see it get much lower. Like sometimes they're 10% and things like that. But in the early days, I would expect to take dilution. And this is for everybody. This isn't just for the management and the employees, but also the early investors take dilution. And so I think that's just something people always need to be mindful of. I used to have an investor that said, pigs get fat and hogs get slaughtered. And I love that quote because I said, if so many people are trying to protect every little dollar in equity, I'm like, you can own 100% of $1 million business, or you can own 5% of $1 billion business. Which one do you want? Right. Bill Gates probably owns, I don't know, definitely less than 10% of Microsoft. And I'm sure he's just happy.
Yep. He's doing
okay.
Yeah. He's doing fine.
I think Jeff Bezos owns something like 16% of Amazon.
Yeah. Jeff Bezos owns a lot more than most people at that stage of a company. But he did something that was pretty interesting is I think, took down some debt, or I forgot what he was doing, but it was non-dilutive equity back in the day. And that helped him to have a lot more ownership.
Interesting.
So that $100,000 investor, sorry to hang on that. You valued the company at some point to give him ownership of what he was buying into. In the most second grade explanation you can give, how did you do that? How did you assess the value of your company at that time to determine his ownership?
What happens, and this is art and science, and typically I would say that it's whoever your investor is going to set the price and the value. You can come in there all you want and say, oh, my business is a $20 million business. And they'd say, no, I think it's worth 10, take it or leave it. And so that's your choice on what you want to go do there. But I think they will typically, for especially more sophisticated investors, like they know what they're doing and what's reasonable. Markets also change a lot. Like I thought the last 3 or 4 years was completely beyond bonkers. I'm like, what are we paying for here? These are crazy valuations. Very company like WeWorks is a good example. What the hell is this? And so sometimes you can see a company that will be, I think, overly valued and create this FOMO from investors, and that drives the price way up. So that can happen. But again, I think most of the time you go in there and you look at some of the fundamentals of the business, and then you can also think about, okay, what can it become? So like a good example would be Facebook early on. Lots of users, no revenue. So how do you value that business? So that's what I mean. It's art and science where you look into the future and say, man, if these numbers keep scaling like this, and then you can come up, sometimes you'll think of different hypothetical business models, and then you discount it back to present day and go, okay, I think it should be worth X. So I don't think my point is there's not a perfect explanation, but it is a little gray, I'd say.
Who makes those valuations? The VC firm that's doing the round?
Yeah. You can push and say, hey, I want to raise in this range kind of a thing. But if you can get competing term sheets, so let's say you go to 4 VC firms and every one of them gives you a term sheet, you're going to see that they're going to be a little different in there. And value is one thing. I think valuation is one thing that matters. But there's also a lot of other things, as you guys know in real estate, that are even more meaningful. What are the other terms that are in here? And there's all these different terms you can put in any kind of deal. And sometimes those things have more weight than the valuation itself. Like you might say, I'm going to take a lower valuation because I just have a cleaner term sheet. And those are all the things.
And that investor that sold some of their shares, basically they owned a percentage of the company. And then a new investor came in and said, hey, we're valuing the company much higher. And then they decided to sell shares and make that excellent return. And that's essentially how you expect to make money as an angel. Is that right?
Well, in that case, it was somewhat unique because we had a lot more demand for our financing at the time. And so we were trying to find ways to get some strategic investors in. So we did what they call a secondary. Who else is already invested that may want to sell some shares? So that was very strategic in doing that. In other cases, it's more of you're just in it and waiting. You're waiting for that thing to either that entity to get acquired or end up going public so you can ultimately sell your shares. But yeah, I think the challenge for anyone investing in private companies is there's no liquidity. Like you're just on the ride, right? You've written your check, just ride. In a public market, you can buy and sell or do whatever you want. But I think the returns look different, right? If you look at some of these companies that have been hugely, wildly successful, they always look a little crazy in the early days. And so most people are like, oh, like remember Amazon, when Amazon first went public, everyone's this thing's going to die. This guy's selling books and like, oh, it's so overvalued, blah, blah, blah. But if you knew Jeff Bezos and you talked to him and I don't know what he was saying or sharing his vision, that's what turned it into what it is today, not the books. The books was just chapter one.
Yeah. Totally.
So
Nick, you have a lot of experience and you've gone through a lot. You've very successful, had some failures. What in the last 6 months have you realized that you haven't shared with anybody or is a new way of thinking that maybe you've learned that comes to top of mind?
So I've had a lot of free time the last 6 months because I spent 4 of it traveling. I took my kids out of school and we traveled around the world. But what I was doing, so sometimes, again, if people are starting companies, I think it's really good to take time and just do nothing. And it's really hard. But I started writing a lot about things I was doing or wanting to do and trying to think about, okay, what do I want to do the rest of my life? And building companies, I love it. But then I wanted more of a theme, right? I was like, what's even bigger than me? And so I started to get real clear on this concept of circularity. So I'm very passionate about the environment. I'm very passionate about what's happening in the world. And part of it is I've had over a decade watching billions of dollars of secondhand goods exchange hands. So I can tell you like what stuff sells in Arizona versus here in Bellevue, Washington. Like I have a really good pulse on those things. And so I started looking at like the biggest things for the biggest impact I can make as a legacy would be focusing on circularity. And what I mean by that is we live in a very linear world for the most part. Things come to us and then they get disposed and they just get gone. But everything we need is all around us because we've been shipping stuff here since the 1950s, like post World War II. Once we started to become like a real globalized society, think about it. Like all the plastic you need, every piece of furniture you need, gold, minerals, all that, it's all around us right now. The challenge, of course, is how do we unlock it? Like, how do we create a more circular environment? And so I think that is the big view I have my vision for the rest of my life, which is creating circular opportunities to make more of an impact. Because I think if we want to solve the climate challenge, we have to do things more locally. And so it's everything from spending time focusing on things from like waste management companies. And it's really, there's a lot of innovation in that space. So for people that think about trash, it's not trash. It's just value that we haven't been able to realize very well. But now you got things like AI powered robots and there's companies now taking that waste stream and turning it into value, which is interesting.
That's very interesting. Actually, I never really even thought about that. AI technology on display. There are so many valuable things that people throw away just because they don't assign value to it, but it's very valuable.
I have another new venture I'm working on that is free pickup. We will come to your house and take things for free from you. Why? Because that doesn't exist today. Today, again, in America, if you want stuff taken from your house, you have to pay them to take value from you. And again, we're not doing junk hauling, but we're taking things and trying to find a sustainable way to sell those things. That's another thing that we're working on. I'm very focused on the energy side of things. So if you want to get to a cleaner future, we need to get EVs are going to happen. That's going to happen. And I believe autonomous is going to happen. So fast forward in the next, say 10 years or so, I think you're just going to hit a button and you're going to get a couch delivered to you from across town for less than $5. Once you remove the driver and the gas, the economics become very different. And I think that'll be a huge unlock for circularity. You'll be able to move goods all around the place, all around, and you'll be able to find new ways to realize value out of things. So I think that needs to happen. So anyhow, those are, I'd say the last one is really measurement. So I've been thinking a lot about this climate challenge, and there's a lot of lofty goals and things people want to do. No one's really held accountable because no one's really measuring it the right way. But we can do this, and we've done this 2 times. I'll give you 2 examples that are interesting. Credit scores. One bank adopted the credit score back in like the 50s or maybe the 60s, somewhere in that decade, I think. And then everyone adopted it. And now everyone knows what a credit score is. When I was a kid, we never had nutrition labels. Remember how much sugar we used? Nobody drank water when we were kids. We drank Capri Suns and soda. And then I think it was like 90s or something, like we had to put nutrition labels on everything. And then everyone started paying attention to calories, but we're not doing this for the environment. And so I think every single thing that's out there that's made should have a simple QR code on it. And it should break down all the elements of like, what is this thing? What did it take to actually produce it? Does it have a second life? Does it just go into disposal? Like, we need to have that. So there's a few companies I'm trying to get involved in to help them to, how do we build this in the right way? And then bring it to government. Government has to be the one that enforces these things. So anyhow, that was my long way of saying, what did you hit me? You hit the bullseye there where I'm very passionate right now. And it really comes down to circularity though. You need to do all these things at a system level to unlock all these things. You can't just do one thing. And sometimes I think people feel bad, like, oh, I'm not recycle enough. Like, great, that's one thing you can do, but you need to be doing a lot more of those. And so that's my hope for the rest of my life, is I can actually be on my deathbed and say, man, I actually moved a lot of these big tectonic plates that actually made some level of impact.
That's so great.
Really.
Nick, I know we're up on time. I want to be respectful of yours, but I have a quick 2-part question here just to wrap things up. The first one is, Ryan and I are doing what we can to share alternative investments with the pilot community and other professionals who listen to the show. I think pilots tend to be very stock market heavy, and they don't realize that there's this whole world of investment options outside of stocks, bonds, mutual funds. We're big real estate guys, but for somebody who's making $300,000, $400,000, $500,000, $600,000 a year, do you think that there is a place in that person's portfolio for VC? And if so, how can they learn more about it and get a little smarter on it?
I think it all comes down to the individual. If I think about it for myself, I'm just naturally pretty curious about things. So I will explore and try to understand and learn these things. So I would never, like, I'm an investor in a few funds, but I understand that. Had I not, I might be a little bit more reticent. So I'd say, if somebody's interested, they don't just write a check, do some homework and get comfortable with it, and then find the right people that resonate with you. And there's certain funds that invest in certain areas and certain funds in different things. Find those things and say,
are there any books or resources that you'd recommend to the listeners?
Not particular around like venture capital that like give you the guidebook. You can read plenty of like biographies and startup stories, but I can't think of any one that's, here's venture capital and how it works. Maybe there is one. I haven't read it. Yeah. So I think that get out there and find things that interest you. And then if you can, try to talk to some people and say, hey, maybe you can get involved. I think the challenge might be, again, depending on the investor type, it will be more of, can you get in and write a meaningful check and they'll spend the time? If you're going after a huge firm and you say, I'm going to give you a few $100,000 and maybe I don't have time for this. So it might be, depending on the check size people are looking to write, it might be easier to find smaller kind of firms that are writing smaller checks and say, hey, I like what you're doing. I love the companies you're investing in. I give you some dollars to manage for me. There you go.
Well, Nick, we really appreciate you coming on, sharing your story. I had a lot of takeaways, and I know that our listeners learned a lot about the basics, right? What's an angel? What's a VC? What's private equity, and the role they could play or can't play, and each stage of that, and maybe some things to think about. So I wanted to thank you for coming on, and appreciate your time.
Thanks for having me. It was fun.
Thanks, Nick.
On to the next show. Thanks, everybody, for listening. We'll catch you next time.